Hi, I am Jorge. I'm running The Officials, a new publication covering the physicals and derivatives markets. You want to know about what is really happening? Read it. You want to hear about the real stuff? Come and watch. I am The Official. Hello, everybody. This is Jorge, the head of The Officials. This is our second edition of the podcast, and I would like you to like it and subscribe it. Please do that. And next, I would like to introduce the members of the panel. To my immediate left, I have Harinder Sandhu, one of the permanent officials, and then Harry T., who is, by all practical purposes, a permanent, but is a permanent guest, I want to say, and very helpful in these operations. And then Dr. Wu, otherwise known as Vincent, but he is also a very critical member of the officials. Thank you very much, and please enjoy the show. The purpose of the meeting today is to address, well, the key point going on today and this week, the major collapse in markets. It's very serious. It's very broad. It is affecting any commodity we can think of, with very few exceptions. I have never seen anything as broad as this in what seems to be a normal day, but it is not a normal day. We had massive drops in crude, in gasoline, in diesel, in natural gas, in copper. I mean, the list just goes on. I recommend that you go into LinkedIn, into the Onyx hub, download the officials, and we have there highlighted some of the main commodities that have dropped. I'm going to pass it to Harinder to let us know what are the main commodities that fell.
Absolutely, Jorge. So as you said, there's been falls across commodities and indeed equities as well. In particular, we noticed that aluminium, the CME aluminium contract, dropped by about 2.2% over 5 days, which is near 18-week lows. We also saw cotton fall by about 6.2%, which is the lowest since the 4th of October 2020. Another notable one for us, as Jorge mentioned, is copper, which is typically used as a barometer for the health of economies. We saw that fall by about 4.3%, and it's down now about 20% since earlier this year. So significant falls in copper as well. We've seen gold, which again saw a huge rally earlier this year, take a hit of about 3.2% in the last 5 days and preparing for further retracements downwards. Equities, Tesla saw a drop of about 13%, the lowest since the 1st of July. The S&P 500 down about 3%. And on that S&P 500, Nvidia, which is we all well know, rallied aggressively earlier this year, saw a drop of about 6.3% on the day, so hugely significant there. The Nasdaq also down about 3.6%, the lowest since the 11th of June. So across commodities, across equities, we've seen falls.
We have been bearish. If you read our documentation and the positions we have stated, we mentally have our opinions, is on markets being down and heading down. And we have been surprised about the market resilience because it hasn't dropped as quickly as we thought it should. But it was like a death of the 1,000 cuts. Each little bit of information that was coming out was negative. And GDP here and there was negative, expectations negative, sales down, PMIs down. Everything with the exception of data in India and today in the US has been negative globally. So I would like to pass it on to Harry to give us an overview of what are these drivers pushing down all this essentially negativity across commodities and equities.
It's hard to say, but as you say, it's broad-based. So other than bond markets rallying, and so yields coming off and expectations of central bank policy in the US veering eventually to some form of easing, I think there's a lot of pessimism, and a lot of this pessimism, as you said, death by 1,000 cuts. We've been having a string of negative data out of China for some time now. And this week has been rather exceptional because the central bank intervened twice this week, which is extremely unusual. affecting 3 of its policy rates. In an effort, of course, to support an ailing economy, both in terms of manufacturing, property sector, etc., as we know, and China's health, especially for commodity markets. So Dr. Copper, to use a Bidenism, is sick. We're looking at oil also feeling the impact of weaker possible Chinese refinery runs because domestic demand is not performing as well. So I think China is extremely central to what's going on in a context of speculation of how central bank policy may emerge. And here, I think the interesting question, and you and I discussed this earlier today, is that this difference that's happening in terms of movers. When we talk about movers, typically we tend to see the Fed lead the moves on the upside and then eventually in the easing cycle. This time around, the Fed is effectively the laggard. The ECB has already moved. We're expecting Bank of England to move and cut rates when it meets in early August. Yes, there's an expectation for the Fed to cut, but it will come in September. China's central bank is now moving a little bit more aggressively than what its normal stance is when it conducts its monetary affairs. And I think it is this concoction that is leading to a lot of the turmoil that we're seeing in markets today.
Yeah, it would seem that the US has lost that leadership in economics, where the book is now written elsewhere, in interest rates, in economic activity, in market demand. Everything is really happening abroad. And with essentially Trump coming in, or most likely coming in by February next year after the elections in November, that isolationism is likely to grow further. So, Dr. Wu, what are your thoughts? Do you think the US will kind of go into a shell and China will continue to be the leader, even if it's of ill tidings, as Harry essentially was saying? What are your thoughts?
It's, of course, difficult to speculate what's going to happen next week, even less so what's going to happen in half a year's time. However, for all the talk about Trump being rather isolationist, people like to talk about history, what has happened before, but it's worth mentioning that Trump's first ever foreign trip was to Saudi Arabia. He's also, because of his actions, like it or not, it's sort of spurred European countries to increase their defense spending as a proportion of the GDP, as well as Trump interacting, calling Xi Jinping a great old friend, and I do expect that to continue. And he has also mentioned in one of his previous rallies about how he thinks his friend Kim Jong-un must miss him. So I believe it won't necessarily be an isolationist foreign policy, perhaps from the European perspective, more so that Trump will try to interact with most other foreign leaders in order to try to play on all sides.
And that brings me to a question: will they actually have tea in the demilitarized zone if indeed President Trump misses his old North Korean friend? But I think it's quite interesting, the points that Vincent has raised. At the end of the day, is Trump 2.0 going to be the same as Trump 1.0? By many standards, yes. And when it comes to corporate taxation, deregulation, making America great again is obviously reinstating U.S. energy dominance, and that is obviously less reliance on energy abroad, but also on countless occasions, Trump has said, we will be the supplier of energy to the world. So whether it's crude oil exports that are now feeding Europe and helping to replace lost Russian volumes, or whether it's going to be gas in the form of LNG, a lot of those things are going to remain the same. Then after that, of course, is what's going to be different with Trump 2.0. What can we think could be different with Trump 2.0 that he hasn't done last time, to throw a little bit of sparkle, if you will, or jitters, depending on what he does, into the market.
Yeah, I think people tend to revert to their natural personality over time. And he is very American and bats for America, and that would suggest some form of isolationism. In addition, he likes energy to be cheap. and tries to push people to produce a little bit more. This is why in the last edition we talked that over the long term, this was more bearish than normal for oil. And if in the short term we have China weak at the knees and all the signals coming out of the Chinese economy is that they're really not doing well, then we have weakness in the front end and weakness in the back end for energy. And then if we try to take a broader point of view, then we have all the data coming out of the PMIs in Europe. And any of the Harrys here, Harinda or Harry, do you want to add some more light on the European PMIs?
Yeah, so we've seen very, very weak PMIs out of France, Germany. Interestingly, I think the UK PMI was up to 51.8, so some expansion there, but indeed weakness.
Like a tiny little one. The one that worries me the most is Germany, because Germany has been the industrial engine for Europe, and it's flat on its back. And industry, manufacturing requires energy. And some of that energy formerly was nuclear, was oil-based. Now you have more renewables coming in. So Europe as a sink for hydrocarbons doesn't look too good.
The interesting thing, of course, about Germany, and you highlighted industrial activity, which obviously is not just a manufacturing process, but the freight that accompanies the movement of merchandise goods. We've been looking obviously at a lot of weakness in diesel demand. And this weakness in diesel demand and in diesel prices generally has weighed quite critically on the refining margins of a number of European players, not least a big major French integrated company whose results came out today and who actually singled out.
We wonder who.
But having said that, it is, of course, extremely indicative of when you come to looking at now just focusing a little bit on oil, about a situation which could put OPEC between a rock and a hard place. We're talking about more supply, right? Weakness in demand. Dr. Wu has been reminding us that President Trump and Saudi Arabia have had a special bond. And so if you try to think about all these things put together, you start looking at if indeed Saudi Arabia and other producing countries need an elevated oil price, it is going to be extremely difficult in the demand context, in the non-OPEC plus supply context, to withdraw any of that voluntary supply restraint. They're going to have to leave it in place. And they've indicated that market conditions will dictate whether or not they put oil back on the market. And I think the market conditions are pretty much forcing their hand to keep this ship steady as she goes. Otherwise, we're in, as we were talking about in the last show, not for some equilibrium price between 80 and 85, but probably something closer to 70 and 75. So OPEC meets, I think, Vincent, on the 1st of August for its Joint Ministerial Monitoring Committee. And this is, of course, not a policy-making body, but it's certainly going to be interesting in terms of soundings. So if we were to elaborate more on OPEC, what are your thoughts?
Yeah, so the next, the JMMC meeting in August will set a precursor for official policy later in the year. There's also been headlines about Russia actually correcting their previous overproduction, right? So that will be spread out into next year. That will.
We'll have to see if that's lip service or reality, but at least they've come out and said something about it, yeah.
Lip service is free. Action cost. So let me bring it in here, and I'm going to disclose my hand. I was very vocal all this morning internally that everything looked ready for oil to breach 80. And then the next stop would be 78. I was sure. Then the GDP figures came out from the US and came out much firmer than expected. So there are always surprises in the market. But nevertheless, this is a point of light in maybe 100 negative ones. So let's start here, going here. Dr. Wu, what will come first, 75 or 85?
85.
Harry T?
75.
75.
Yeah, I am on the 75 range, but I am more on the 78 range. So with that, folks, we will see what happens, and I guess our expectations are for, let's say, mid-August. Let's see who is more right. Thank you very much for today's session.